this particular computer, ThinkPad Ts aren't really meant for heavy AV work, and it shows with this particular ThinkPad T in front of me with this T series ThinkPad. So we're going to, kind of skip on that today. If you want to really see it, if you're really desperate to see it, we actually can show you. And given that this is the video quality that we have here, we're not going to spend a lot of time with the camera turned on me. We're going to be on the slides much more this week than we usually are. So just fair warning. We also have a slightly different sound because I'm on the road. I'm in Columbus, Ohio. Right. This is the current federal tax developments for the week of August the 22nd, 2016. Current federal tax developments, as always, are brought to you by Nichols Patrick CPE Incorporated and your state society of CPAs. This week, we're going to look at the question of being reasonable, as we've had a couple of cases dealing with that particular issue. Now, I may sound different this week, and certainly I would look different on camera. I'm going this week from Columbus, Ohio. I'm here at the Hilton Garden Inn early on Saturday morning, recording this before I head out of town. And I'm also recording because of that. I don't have an actually full sound recording rig with me. I'm using a USB microphone, which is a Blue Snowball, so I may sound different. And certainly if I turned the camera on, I would look very different. Tested the camera before we got here, and honestly, the ThinkPad T series laptops, they're wonderful business laptops, but they really were never meant for audiovisual. Now, some of the issues we'll do this week, we're going to look at some highlights this week. We'll talk about the question of a taxpayer who discovered the problem that how we measure starting a business. We're going to take a look at the question of receiving permission to change your accounting method and a case where a taxpayer failed to receive it, but perhaps the IRS shouldn't have worried about that fact. We're going to talk about the question of potential employment status of household employees. In this case, we're going to look at an adult companion problem. And that's interesting because there's actually a special code section that deals with those agencies that place adult companions that get them out of being the party that is the employer, but may cause the recipient of the services to become the employer. We have a couple of reasonable cause cases coming up. The first one's going to look at a partnership that had the rare case of being able to show reasonable cause for having poor information, unreliable information, so they couldn't finish their return. That's a rarity, but there's an interesting set of facts as to when it worked. We'll look at a not-for-profit corporation that discovered that it was going to be hit with the lower interest rate being paid to it on overpayments because it was considered a large corporation. And we'll take a look at the taxpayer who had reasonable cause for not filing this taxpayer return, her return, because she made a mistake believing which year an item would be deductible. And the court found, given her background, that was also reasonable. So we have a couple of interesting fact-based cases for reasonable cause. Now, coming up this week, I've got a few courses coming up. On August the 22nd, that is Monday when this is released, I'll be doing ethics and quality control in tax practice in Phoenix. That'll be both a webcast and a live course. Also on the 24th and 25th, then later next week on Wednesday and Thursday, I'll have courses in Albuquerque. I'll be doing construction contractors, special tax and accounting considerations in Albuquerque on Wednesday. Thursday will be corporate taxation, subchapter C for CNS corporations, also in Albuquerque. And then I take a little time off of being on the road. And September 7th and 8th, though, I end up in Cedar Rapids, Iowa. Get the right I state. And I'll be doing fringe benefits there on the 7th. And on the 8th, I'll be doing a course, a new course for us this year, real estate partnerships, getting in, getting out, and getting taxed in Cedar Rapids. So if you're around, want to attend one of those courses, be sure and sign up. Again, we'll have more courses coming all through the fall as we get into the major season where CPAs take their continuing education. Let's go on to the first case this week. This is the case of Tizard versus Commissioner, Summary Opinion 2016-42. It was issued on August the 15th of this month. And this was a case of a taxpayer who she was a pilot for an airline. Now, airline pilots, commercial airline pilots are required to retire mandatorily at age 64. And she was getting to the point where she was approaching that age, and she wanted to have something to do when she retired. So she went out and she bought an aircraft. And this aircraft, she was going to use it to basically do some training, do some teaching to individuals, maybe even use it for. So she had some ideas on it. So she purchases this aircraft in 2010. Now, in 2010, she did, and when she took delivery of the aircraft, she went ahead and she set up, and what she ended up doing, she picked up and effectively first took a friend on a flight. Her idea with taking the friend on the flight was that she could be an incentive orientation flight, was her term, on the aircraft. So she wrote up an invoice for taking this person on the flight that she thought she could give training to, but she didn't charge the acquaintance for the flight. The acquaintance subsequently moved out of state, never did sign up with her for services. When she was looking to buy the plane, when she negotiated with the seller, she discussed providing aerial land survey to him because he had developments apparently in her area. And so she was going to provide these aerial land surveys to him. She claimed she had an oral agreement with him to do this, but they never actually signed a final agreement, and she never actually ever performed such services. She also put a notice up on Facebook in October of that year that she had her own plane, didn't mention that she was going to offer services in it. She said it was a dream of a lifetime, etc. She got 50 likes, shall we say, from her 230 Facebook followers. She later set up a Facebook page for the operation in 2011, but it was targeted by hackers, closed shortly thereafter, and she never reopened one until 2014. She claimed a loss of $13,295 on her 2010 return. She showed no revenue. The court decided that, well, the activities she had undertaken that year did not amount to starting the business. They did not, and nobody claimed that she didn't intend to use this plane for business, that she didn't really intend, and that it was a plan she had. But the court said she hadn't started a business yet. Having not started a business yet, these were Section 195 issues, which were startup expenses, and she had to capitalize those and only be able to deduct them in the year in which she began operations, and up to $5,000 with a potential phasing down of that if you have over 50,000 such expenses, and then over 180 months for any other expenses. And none of that can start going until she actually starts operations. And as the court noted, by the end of 2010, she hadn't started operations. Next up, we have a case here of the case of Nebaker versus Commissioner. This is Tax Court Memorandum Division 2016-155, issued on August the 16th. Now, this was an interesting case because the taxpayer had started his business, Schedule C, and at some point, a couple years later, he began switching to deducting payments made to independent contractors when he received payments, when he basically invoiced his customers. Now, he was in a lot of contracts where he had to account for all expenses on the contract. He could be reimbursed for some. He basically had contracts that covered the whole thing and others, but he still had to account for these. And so he had to carefully match every contractor payment with the, what job it related to. And his CPA had approved of him delaying this deduction. Maybe the CPA even believed he had to delay it. But here's the problem. He had started out charging them off when he paid them. Because of that, a switch to a deferral method would be a change of accounting method. Even if that was required, and by the way, the IRS in this case will take the position it wasn't required, he still needed the IRS's permission in order to change that method. But apparently the IRS didn't realize that was really how they could challenge this. The IRS said, wait, cash basis of accounting, you're supposed to deduct things when paid. He has these deductions for the year in front of us that he paid an earlier year. Tough luck, guy, they're disallowed, and you're just going to lose them forever. The contractor claimed in court that A, this was an allowable way of doing it. The court didn't buy that. But B said it was accounting method change. Now, he argued that because it would have been a method change, the IRS, since they didn't call it a method change, the court had to throw out their adjustment. The court said, no, we can actually get the proper number, and we're going to say this is an impermissible method. We agree with the IRS on that, but we also agree with you as an accounting method. Because it's an accounting method, you need to have a 41A adjustment to basically make everything whole again. Well, if you do that, what's going to happen here, because this would be a negative adjustment, it seems highly likely, although the court didn't worry about this because it wasn't their problem, it seems highly likely that what's going to happen is this gentleman is actually going to get deducted in the year in which the IRS forced him back on the old method, the amount he had basically incurred the prior year, and he's going to get the regular deductions he would get under the cash basis, including ones he wouldn't have taken. So he's probably going to get a claim a bigger loss in the year in question than he would have been able to claim otherwise. He's not going to lose those deductions for the year before because that prior year would be closed. Okay, so it didn't work out quite as well for the IRS as they had hoped. Next up, we have an interesting case dealing with the employment status of an adult companion. This is Chief Counsel Email 2016-33034, issued here on August the 12th. Now, you may not be aware of it, but there is a special rule in the Internal Revenue Code under Section 3506A that holds generally if a companion placement service or a sitter placement service, kind of looks at this generally, so it covers babysitters, companions, etc. If they do not treat somebody as an employee, they will rather, they will not be considered an employee of that organization. So they'll be considered normally to be an independent contractor. But the IRS was preparing some training materials, and they had a paragraph on that, and somebody wondered when doing those materials, well, could this person be an employee of the adult in question? And the national office, in responding to the email, said, well, yep, 3506A makes it very clear that the agency is not the employer. But the adult recipient, even though you went through an agency and got somebody, if they're not treating them as the employee, then the question is going to be, are they an independent contractor, or are they now a household employee of the person for whom they are providing the services? Now, these adult companions are often used, by elderly individuals or people who have gone through, or have just gotten out of the hospital, have various issues. So they need some assistance, but they don't need extreme medical assistance. So they don't need to be in a nursing home, but they do need to have assistance there to help them do some simple tasks during the day. These are their adult companions. In that case, what they've ruled is the issue depends on whether the adult in question has the right to direct and control the companion. If they do, then the memo states that person will be considered an employee of the adult for whom they had the services, even though the adult got this companion, this particular person, and adult companion is a term they use, they got this particular service provider via an agency. It's not considered a payment, an employee of the agency. The agency gets a, will get a commission off placing it, but, it may still be a household employee. So beware of that. Next up, our first reasonable cause case of the day. This case is in regards to Refco Public Community Pool LP bankruptcy court case for the District Court of Delaware. Case number 14-11216. You'll find it as 118 AFTR 2nd, paragraph 2016-5085. The opinion actually came down on August the 2nd. And this is a question, it's a bankruptcy court case, and this partnership's in bankruptcy. That's why we're, the district court, the bankruptcy court in Delaware is hearing this case. And this particular partnership had not filed partnership returns for a few years. And the IRS in the bankruptcy case is saying, well, we have a claim against them for the penalties for late filing penalties. As we're all aware, giving the $195 a month penalty per partner, if you have very many partners and you're very late, it could be a very expensive penalty. And in this case, it was an extremely expensive penalty. The amount in question was $3,662,000 for the years 2005 to 2007. And the partnership had clearly not filed the return. So that wasn't an issue. The question was, can they get out of it? Because this particular penalty can be gotten out of, a late filing penalty, for reasonable cause. In this case, what happened is that this particular company had invested all of its assets with funds from what the Spinks group, actually you'll read it in there. And that particular group, turned out there were some problems that arose there. There were accounting problems. It went into bankruptcy. They discovered that there had been loans to related parties. It hadn't been reported properly, which of course changed the whole view of what the real assets were. Many of the people holding, because they had a bunch of partnerships they had established to be investment partnerships. Many of the people who had interest in that obviously asked for their money back, including this partnership. They received instead some special rights, special interest items. And then the whole enterprise up there went into receivership in Canada, and a receiver, I should say not in Canada, this was actually in this particular case, this one was done in an offshore location, which was not Canada. In this case, it was actually a location where it formed it that was sitting down in the Cayman Islands. So the Cayman Islands got control of this. The Grand Court of the Cayman Islands appointed a receiver, basically somebody to liquidate it out. Well, they got in there and discovered the books were a horrendous mess. In fact, they discovered that it was just terrible. So they stopped filing 1065s for that group, because the people there said, we can't give any sort of reliable numbers for any of these partnerships because everything's commingled, mixed up. The records are a mess. We don't really know what anybody has. Now, Refco Public Community Pool, LP, its problem was that the only asset it held was this partnership interest now, for which it wasn't going to get any K1s. And while it got some financial information for the overall Spinks Group set of funds, A, it had no detail on its fund, and B, every one of those came out with a note from the receiver that these cannot be relied upon. We expect they're wrong, and nobody should try to use this for anything. So the partnership did not file tax returns for 2005, 2006, 2007. The IRS, of course, said, hey, you're supposed to file returns. And merely not having perfect information is not, and it's generally been true, we've had lots of cases on this, is not considered reasonable cause for not filing a return. Because let's be honest, nobody ever has perfect information about their tax return. But in this case, the bankruptcy court in Delaware found that this was such an extreme case, and the only information they were told was wildly unreliable, that it was reasonable for them to be concerned that if they actually issued those K1s and used them, they'd be penalized for grossly understating or, misstating their income. They also were probably concerned about liability from the partners if they overstated the income. The partnership therefore had reasonable cause for not filing the return. Having reasonable cause for not filing the return, the partnership therefore did not owe the $3.6 million in penalties, and the IRS was out of luck. Now, be very careful. This is a very unique facts case. It's not going to hold up for most people to be able to get out of their penalties by saying, oh, no, I didn't get a K1. Remember, in this case, those K1s were the only K1s in question. And normally, if you could estimate what should be on those K1s, you would do that. So I could reasonably estimate what should be on my return. Well, they couldn't do that either. So that's the fact pattern, I think, that made this court, which I will point out is a bankruptcy court in a single district, so your mileage may vary elsewhere, to rule that it was okay for them to delay filing the returns until the whole liquidation process was finished up for these partnerships so they would know what they really had. Next up, we have a not-for-profit hospital that had an overpayment of payroll taxes. This is United States versus Detroit Medical Center. This is a Sixth Circuit case number 15-1279. The decision came down on August the 17th. Now, they received a refund of their payroll taxes, and they received a payment of interest. But the hospital group was a little concerned at that interest payment because it wasn't nearly what they thought it should be. And they protested to the IRS that you underpaid the interest on this refund claim. And the IRS said, no, we didn't, because you're a large corporation. And Detroit Medical Center said, no, we're not for profit. They said, well, you're a corporation under Michigan law, and you meet the requirements for a large corporation. Now, they said, no, we don't. We don't meet the requirements because the requirements would require us to be a C Corp. This is where things get interesting. And as the Sixth Circuit notes, first thing the Sixth Circuit said is clearly you're a corporation. So we're not going to say that somehow not-for-profit organizations are not corporations, because they did try to argue that too. They said, no, you're clearly a corporation, so we're going to go with that. Now, what they tried to argue here was that 6621A1 defines says the overpayment rate shall be, reduced if the extent overpayment for a corporation for any taxable period exceeds $10,000, right? We end up changing that. And effectively, the federal short-term rate determined under subsection B plus 3 percentage points or 2 percentage points in the case for corporation. In this case, we have a large corporation structure here. So we have a reference coming cross-referenced. A1A, which talks about the large corporation as defined in the reg. This large corporation is defined at C3, and that tells us a large corporate underpayment is an underpayment of tax by a C corporation for any taxable period if the amount of the underpayment for such period exceeds $100,000. Now, they made a cross-reference to the definition of a corporation when they were doing that. So they said the cross-reference to a corporation that would be considered a large corporation under that reg, for the tax periods. Now, the court said, the catch here is the parenthetical most naturally modifies tax period, they say, and not corporation. And so the problem here is, since it modified tax period, if you look at 6621, they're saying that they were defining a tax period. They didn't really worry about it being a C corporation. They ruled that, in fact, this overpayment provision applied to all corporations, whether they were a C corporation or not. And we should say the court did note that they agree with the Second Circuit that held similarly in an earlier case back in 2015. So now we have the Sixth Circuit and the Second Circuit both agreeing that if you're getting a refund, remember, a not-for-profit most likely is getting a payroll tax refund, they still will get a reduced interest rate if they are a large corporation. So if the not-for-profit is organized as a corporation, which most will be, and they meet the large test, they're going to be considered to be having to get the lower payment rate. They won't qualify for the higher rate that an individual or a partnership or a trust would be able to receive. Next up, we're going to take a look at another reasonable cause case. This is the case of Rogers versus Commissioner. In this case, the taxpayer had a fire in 2006 and 2007. That resulted in losses. Now, the catch was she had a fire in her apartment in 2006. It caused her to have to shut down her business because she ran her business out of her apartment. It appears to be in New York. She then, when she was going back in, she was back in the apartment to pack things up, and the power was apparently off, so she had candles, and it appears she lit the place on fire again. We're not sure. We know she was working by candlelight, and we know that there was a fire. Seems like candlelight with a bunch of papers that you're trying to get out, that could cause a problem. Whatever happened, the place caught on fire again. After the second fire, the city ordered her to stay out of that apartment until they ruled it was okay to be lived in. And the other thing that happened at that point was a local newspaper discovered about this fire issue and wrote up about her. And obviously she became very unpopular with her neighbors because they happened to believe that she was likely to burn the place down, would be apparently what they took away from the newspaper story. And since her apartment was attached to their apartments, they were a little concerned about that problem. Now, the second fire, she had a dispute with the insurer that she was concerned about what the claims be. She had these large losses, and the insurance company, she was trying to get the insurance company to pay for everything. They finally settled the matter in 2009. She filed all of her tax returns until she got to 2009. Now, she had believed, based on her own reading of the code and reading of rules, which she, by the way, had always done her own returns. She had done them. It had always worked for her. It had been fine. She did her own research, and she had concluded, based on her fact pattern, that it would be fully deductible in 2009, and she concluded that because of that, she didn't have to file a return. Well, the court and the IRS found that, in fact, given the specific facts of her case, really the deduction should have been in 2007. She even admitted when the IRS, examined her and looked at the facts, she immediately conceded after they pointed out how you should have read this, that 2007 was the year she should have claimed the deduction. So she basically lost the deduction. But she agreed she owed tax for 2009 because she had no deduction, but she did protest having to pay the late filing penalty. In this case, the tax court found that, in fact, she had acted reasonably. The point being, it's reasonable cause for late filing if you reasonably determine that you do not have to file a return. Now, they said you have to act reasonably. You have to, understanding your background and your history, we take a look at what's reasonable. They said because of the confusing nature of the proper year to claim a deduction in a case like this, and because she made a real attempt, and let's be honest, one thing that's going to help her in this case is she is giving up this deduction entirely now because 2007 is a closed year, 2009 is her late filing year. She's just basically stuck. And she had always filed on time. The court said this is radically different from somebody who is perpetually filing late and who is looking for an excuse. It's also and it's